They tried everything. For weeks, we have been warning you. We told you that as the monthly options expiry approached, the commercial banks would get desperate. We told you that they would use every weapon in their arsenal. We told you that they would paint the tape red, that they would trigger your stop losses, that they would try to convince you that the bull market was dead. Today, they pulled the trigger. Look at the chart on your screen right now. What you are seeing is not a market. What you're seeing is a crime scene. In a matter of 47 minutes, the price of silver collapsed from its morning high of $93.40 down to $85.67. That is a drop of 8.2% in less than an hour. Let me say that again. An 8.2% crash in 47 minutes. In a normal functioning market, a critical industrial commodity does not lose 8% of its value in less than an hour. Not unless something catastrophic happened. Not unless a massive silver mine collapsed. Not unless a war ended and released strategic stockpiles. Not unless a new continent of silver was discovered beneath the Pacific Ocean. None of those things happened today. Check the news wires. There was no mine collapse. There was no geopolitical resolution. There was no supply shock announcement. The fundamentals did not change between 9 a.m. and 10 a.m. Eastern Time. The industrial demand that existed at 93 still exists at 86. The solar panel factories in China did not suddenly close. The battery manufacturers in Korea did not cancel their orders. The medical equipment companies did not stop needing silver. So what happened? What you witnessed today was a coordinated assault, a precision strike designed in the war rooms of Wall Street and executed with algorithmic perfection. They did not sell silver today because they believe silver is worth less. They sold silver today because they needed silver to be worth less. There is a massive difference between those two things. Let me explain what really happened. Today is Thursday. Options expiry is tomorrow. There are approximately $4.7 billion worth of call options on silver that are set to expire this week. These are bets that the price will go up. These bets were placed by hedge funds, by retail traders, by institutional investors who saw the same thing we saw. They saw the supply deficit. They saw the industrial demand. They saw the Shanghai premium. They bet on higher prices. But here's the problem. For every call option that wins, someone else loses. And the entities on the other side of those bets are the bullion banks. If silver closes above $90 tomorrow, the banks who sold those options are on the hook for billions in payouts. Billions. With a B. That is not acceptable to them. That is an existential threat to their quarterly balance sheets. So they did what they always do. They cheated. The KBC Group, one of the most respected institutional analysis firms in Europe, just released an urgent market update. They called the volatility we witnessed today, and I quote, truly incredible and historically anomalous. They are being polite. What they really mean is that this crash was manufactured. It was engineered. It was artificial from start to finish. This brings us to the first critical question. How do you crash the price of a commodity 8% in less than an hour without any change in fundamentals? How do you move a market that large, that fast, without a single piece of real news? The answer is leverage. The answer is paper. The silver market has two layers. There's the physical layer, where real metal changes hands between miners, refiners, manufacturers, and investors. Then there's the paper layer, where contracts representing silver are traded back and forth hundreds of times before anyone takes delivery. The paper market is 250 times larger than the physical market. Let me repeat that number. 250 times larger. When the banks want to move the price, they do not need to sell physical silver. They do not need to touch a single ounce of metal. They simply flood the paper market with sell orders. They use leverage to create an avalanche of contracts that overwhelms the buy side. They know exactly where your stop losses are. They can see the order book. And they drive the price directly into that pain point. That is what happened at 9:47 a.m. this morning. Someone, and we will call them someone for legal reasons, dumped 847 million ounces worth of paper silver onto the market in a 12-minute window. To put that in perspective, that is more silver than exists in all the registered vaults of the COMEX combined. It is more silver than was mined globally in all of 2025. It is a phantom supply, a ghost avalanche designed to trigger panic. And it worked. For 47 minutes, it worked. The algorithms saw the selling. The retail traders saw the red candles. The stop losses triggered in a cascade. The price fell from 93 to 86. The options that were in the money suddenly became worthless. The banks wiped billions of dollars of liability off their books. They tried everything, and for 1 hour, they won. But here is what they did not expect. Here is what they could not predict. The physical market did not follow. While the paper price crashed to $86, something extraordinary happened in the real world, something that exposes this entire operation as fraud. In part 2 of this emergency broadcast, we are going to dissect the mechanics of the paper raid in forensic detail. We are going to show you exactly how the banks use the COMEX to manipulate the price without moving a single real ounce. And we're going to reveal the first evidence that this crash has already backfired spectacularly. The paper price says $86, but wait until you see what the dealers are actually charging. If you're just joining us, you need to understand what happened this morning. Silver crashed 8.2% in 47 minutes. No news, no fundamental change, just pure unadulterated manipulation designed to save the banks from options expiry. Now let us go deeper. Let us understand exactly how this machine works. The COMEX is the primary exchange for precious metals futures in the United States. It is owned by the CME Group, a publicly traded company. On paper, it is a marketplace where buyers and sellers come together to discover the true price of commodities. In practice, it is a casino where the house always wins. Here is the secret they do not want you to know. You do not need to own silver to sell silver on the COMEX. You can sell contracts for silver you do not have. You can sell 1,000 contracts representing 5 million ounces without owning a single gram of metal. This is called naked shorting, and while it is technically regulated, the regulations have more holes than Swiss cheese. When you understand this, the 847 million ounce dump makes sense. No one actually sold 847 million ounces of real silver this morning. That amount does not exist in deliverable form anywhere on the planet. What they sold was 847 million ounces of promises. IOUs, digital entries on a screen. This is the paper game, and today you watched it in action. But here is where it gets even more sinister. The banks do not just have the ability to create unlimited paper supply. They also have access to something you do not have. They can see the order book. They know exactly where the stop losses are clustered. They know that if they can push the price below $90, they will trigger a cascade of automated selling from retail traders. Think about it from the bank's perspective. You are short 50,000 contracts. Each contract represents 5,000 ounces. You're exposed to 250 million ounces of silver at prices around $75. If silver closes above $90 tomorrow, you lose $3.75 billion. But if you can push the price down to $86, even temporarily, you can cover your shorts at a massive profit and let all those call options expire worthless. What would you do? You would do exactly what they did at 9:47 a.m. You would coordinate with your colleagues at the other bullion banks. You would load up the algorithms. You would wait for a moment of low liquidity, and you would dump. The dump creates panic. The panic triggers stop losses. The stop losses create more selling. The selling drives the price lower. The lower price triggers more stop losses. It is a feedback loop designed to extract maximum pain in minimum time. This is not speculation. We have the data. The Commitment of Traders report, which is published by the CFTC every Friday, shows the positions of the commercial banks. Over the past 3 weeks, the commercials have been building their largest short position in silver since 2016. They were preparing for this. They knew the options expiry was coming. They knew they had exposure, and they pre-positioned to defend it. But here is the problem with the paper game. It works until it does not. You can manipulate the price of silver on the COMEX. You can create phantom supply and crash the screen price. You can shake out the weak hands and steal their positions. But you cannot create physical silver out of thin air. You cannot print metal the way you print contracts. And eventually, someone is going to call your bluff and demand delivery. That moment is coming faster than the banks anticipated. While the paper price was crashing to $86, something remarkable happened in the physical market. Instead of falling, the physical price went up. Instead of surplus, there was shortage. Instead of sellers, there were only buyers. We are now receiving reports from dealers across the country, major dealers, regional dealers, online platforms, local coin shops. The story is the same everywhere. The flash crash did not create supply. It created a feeding frenzy. When the screen showed $86, the phones at every bullion dealer in America started ringing off the hook. Buyers who had been waiting for a dip finally saw their opportunity. They tried to buy at the new lower price. But here is what they discovered. The dealers were not selling at $86. The dealers were not selling at $90. In many cases, the dealers were not selling at all. APMEX, the largest precious metals retailer in the United States, has just implemented emergency protocols. JM Bullion has similar restrictions. SD Bullion has posted notices about limited availability. Smaller dealers have simply stopped answering their phones. The screen says $86. The street says something completely different. In part 3 of this emergency broadcast, we are going to reveal the true physical price of silver right now. Spoiler alert, it is not 86, it is not 90, it is not even 100. We are going to show you the proof. We are going to show you the dealer invoices. And we are going to explain why the U.S. Mint, the sovereign manufacturing arm of the United States government, just closed its doors. The banks crashed the paper price, but the physical market just called their bluff. We have established that the 8.2% crash was manufactured. We have explained how the banks use paper leverage to trigger stop losses and save their options book. Now we turn to the evidence that proves this manipulation is failing. The physical market has decoupled, and the proof is undeniable. Let us start with the most important institution in the American precious metals market, the United States Mint. This is not a private company. This is a government agency. It is the official manufacturer of American currency and bullion products. When the U.S. Mint speaks, you need to listen. 2 hours ago, the U.S. Mint posted an urgent notice on their website. They have suspended sales of the American Silver Eagle. They have suspended sales of the America the Beautiful series. They have suspended sales of over 37 different silver numismatic products. Read their statement carefully. They claim they have paused sales to, quote, recalibrate pricing mechanisms in response to unprecedented demand conditions. Think about what they are admitting. The paper price just crashed 8%. In a normal market, that means silver is cheaper. It means the mint should have more pricing power. It means they should be able to source blanks at lower costs and sell products at lower prices. Instead, they are telling you they cannot price their products at all. They are telling you the demand is so high they need to stop and recalibrate. This is an admission of physical default. The U.S. Mint operates on a simple model. They buy silver blanks from primary suppliers. They stamp those blanks into coins. They sell those coins at a small premium over the spot price. If they are suspending sales, it means one of two things. Either they cannot buy blanks at the spot price, or the demand is so overwhelming they cannot fulfill orders. Both of those scenarios point to the same conclusion. The paper price of $86 is a fiction, but the mint is just the beginning. Let us look at the private sector. COMEX, which processes over $2 billion in precious metals transactions annually, has implemented what can only be described as soft rationing. We have obtained internal communications from multiple regional dealers. The picture they paint is alarming. One dealer in Texas reports that his supplier is demanding payment in full before confirming any allocation. A dealer in Florida says his usual 48-hour delivery window has extended to 12 days. A dealer in Arizona says he has stopped taking new orders entirely until supply stabilizes. These are not weak dealers. These are established businesses with decades of relationships. And they are all saying the same thing. The metal is not available at the screen price. So what is the real price? This is the number that will make your head spin. Based on confirmed transactions from dealers across the country, the street price of physical silver right now is between $115 and $125 per ounce. Let us call it $120 as a conservative average. The paper price is $86. The physical price is $120. The difference is $34. The $34 spread represents a 40% premium over the spot price. In a normal functioning market, the premium for physical silver is $2 to $3, maybe $5 during periods of high demand. A 40% premium is not a premium. It is a market dislocation. Let me explain what this means in practical terms. If you have an ounce of silver in your safe, that ounce is worth $120, not $86, not the number on your screen. The number on your screen is a settlement price for paper contracts between banks and hedge funds. It has no relationship to what real buyers will pay for real metal. This creates an extraordinary situation. If you are a large trader, you can buy silver on the COMEX at $86 and take delivery. You can then sell that same silver to a dealer or manufacturer for $120. That is a 34 profit per ounce. That is a 40% return on a single arbitrage trade. Do you think the smart money is not doing this? Do you think the Chinese wholesalers are not backing up the truck? Do you think the industrial buyers are not filling every order they can? This arbitrage is the death sentence for the COMEX. Every ounce that gets bought at $86 and removed for delivery is an ounce that will never come back. The vaults are draining, the registered inventory is falling, and the banks who crashed the price to save their options book have inadvertently created a fire sale for their own inventory. They wanted panic selling. They got bargain hunting. The $34 spread is not sustainable. Either the physical price crashes down to $86, which would require millions of ounces of new supply to suddenly appear, or the paper price rockets up to $120, which would wipe out the bank's short positions. Which scenario do you think is more likely? In part 4 of this emergency broadcast, we are going to look east. We are going to examine the Shanghai Gold Exchange, where the premium over New York has blown out to $14 per ounce. We are going to explain why this specific number means the COMEX vaults will be empty within weeks, and we are going to show you how the flash crash has become a gift to America's strategic competitors. The banks just subsidized China's silver accumulation, and they do not even realize it yet. We have established the crime. We have documented the evidence. We have shown you that the physical price has decoupled from the paper price by 34 per ounce. Now we must look at the global implications, because what happened today is not just about American markets. It is about the transfer of strategic resources from west to east. Look at Shanghai. While the algorithms in New York were busy crashing the price to $86, the Shanghai Futures Exchange was telling a different story. The price of silver on the SFE never dropped below $100. Let me repeat that. While New York showed $86, Shanghai showed $100. The gap between these two prices is $14. In the world of commodity arbitrage, a $14 gap is not a spread. It is a superhighway for capital and metal to flow in one direction, and that direction is east. Let me explain why this matters. Silver is not just a precious metal, it is a critical industrial input. It is used in solar panels. It is used in electric vehicle batteries. It is used in semiconductors. It is used in medical equipment. It is used in 5G infrastructure. Every major technology of the 21st century requires silver. China understands this. They have been accumulating silver for years, not because they want to hoard shiny metal, because they want to dominate the industries of the future. They want to build more solar panels than anyone else. They want to manufacture more EVs than anyone else. They want to control the supply chains that matter. And today, the American banks just gave them a gift. By crashing the paper price to $86, the banks have created an irresistible opportunity for Chinese buyers. Think about it from the perspective of a procurement officer at a major Chinese manufacturer. Yesterday, you were paying $100 for silver. Today, the Americans are offering to sell it to you for $86. Do you hesitate? Do you worry that the price is crashing? No, you buy everything in sight. The $14 gap between New York and Shanghai is the arbitrage opportunity of a lifetime. Any trader with access to both markets can buy silver in New York, ship it to Shanghai, and pocket the difference. After accounting for shipping, insurance, and transaction costs, the profit margin is still over $10 per ounce. At 32 ounces, 150 ounces per metric ton, that is $321,100 profit per ton of silver moved. At the current rate of export, traders could move 100 tons per week. That is $32 million per week in pure arbitrage profit. Do you think this opportunity is going unnoticed? We are receiving reports that the export desks at major trading houses are working overtime. Shipments that normally take weeks to arrange are being expedited. Insurance policies are being written at record pace. The metal is moving. This is the Shanghai vacuum, and it is sucking the life out of the Western vaults. Let us look at the numbers. The COMEX registered inventory of silver stands at approximately 280 million ounces. This is the metal that is available for delivery against futures contracts. At the current rate of drain, which has accelerated dramatically over the past 30 days, this inventory will be exhausted in less than 6 weeks. But here's the thing. The drain was already happening at $93. The crash to $86 did not slow the drain. It accelerated it. By lowering the price, the banks have increased the arbitrage incentive. They have made the drain more profitable. They are burning the furniture to heat the house for one more night. The strategic implications of this transfer cannot be overstated. Silver is a finite resource. The economically viable deposits are being depleted. New mines take 10-15 years to develop, and the demand is growing exponentially as the world transitions to renewable energy. Every ounce that leaves the West for the East is an ounce that will not be available for American manufacturers. It is an ounce that will not go into American solar panels or American batteries. It is a strategic asset that is being surrendered for short-term financial gain. The banks are not thinking about national security. They are thinking about their quarterly bonus. They are thinking about surviving until the next option's expiry. They are so focused on the immediate battle that they are losing the war, and the Chinese are happy to accept their surrender. Look at the numbers from the Shanghai Gold Exchange. Over the past 90 days, the daily trading volume in silver has increased by 340%. The open interest has reached levels not seen since 2011. The physical delivery rate, the percentage of contracts that result in actual metal changing hands, has doubled. They are taking delivery. They are not playing the paper game. They are not rolling contracts. They are demanding the metal, and they are getting it. This is what defeat looks like, not with a bang, but with a ship full of silver sailing from Los Angeles to Shanghai. In the final part of this emergency broadcast, we are going to bring it all together. We are going to explain why the crash to 86 is likely the last major shakeout before the price goes vertical. We are going to give you the strategy for navigating a market where the screen price is a lie. And we are going to reveal what happens when the paper game finally ends. The banks won the battle today, but they just lost the war. If you have been with me through this entire analysis, you now understand what really happened today. You understand that the crash to $86 was manufactured. You understand that the physical market has decoupled. You understand that the Shanghai vacuum is draining the West. And you understand that the banks are fighting a losing battle. Now, let us talk about the end game. let us talk about what comes next. There are only two ways this situation resolves, only two possible outcomes, and understanding which one is coming will determine whether you build generational wealth or get left behind. Scenario 1. The physical price crashes down to meet the paper price. For this to happen, a massive wave of supply would need to enter the market. Dealers would need to find millions of ounces of inventory. The US Mint would need to reopen with abundant stock. The Shanghai Premium would need to collapse. Manufacturers would need to stop buying. Investors would need to stop accumulating. Look around. Do you see any of that happening? The mines are not increasing production. They cannot. The easy deposits have been exploited. The new projects are a decade away. The recycling supply is already at maximum. There is no cavalry coming to flood the market with cheap silver. Scenario 1 is not happening. It is mathematically impossible. Scenario 2. The paper price rockets up to meet the physical price. This is the only path forward. The $86 price on your screen is a coiled spring. Every day it stays suppressed, it stores more energy. Every ounce that leaves the vault adds more pressure. Every dealer that raises their premium adds more proof. When the spring releases, it will release with violence. We are looking at a snapback from $86 to $120 that could happen in days, not weeks, not months, days. The paper market has to catch up to the street price or the exchange will cease to function. You cannot have a market where the settlement price is 40% below the transaction price. That is not a market. That is a fraud. The banks know this. They know they are running out of time. Today's crash was not a show of strength. It was a show of desperation. It was the last bullet in their gun, and they missed. Now let us talk about you. Let us talk about what you should do tonight. First, turn off the screen. The price you see is not real. It is a number generated by algorithms trading paper contracts between banks. It has no relationship to the value of your physical holdings. Looking at it will only cause you anxiety, and anxiety leads to bad decisions. Second, count your stack. If you own physical silver, you own something real. You own something that cannot be printed, cannot be hacked, cannot be defaulted on. Your ounce is still an ounce. And based on the dealer reports we have analyzed, that ounce is worth $120, not $86. The screen is lying to you. The scale is not. Third, understand what happened today? Well, the banks tried everything. They tried the paper raid. They tried the stop loss hunt. They tried the fear campaign. They threw 847 million ounces of phantom supply at the market. And what happened? The physical market shrugged. The dealers raised their premiums. The mint closed its doors. The Shanghai buyers backed up their trucks. The manipulation is failing. Today was the proof. Fourth, do not sell. If you sell your silver today based on the $86 price, you're giving away an asset worth $120 for 30% less than its actual value. You're handing your wealth to the very entities that crashed the price. You are doing exactly what they want you to do. When you feel that knot of fear in your stomach, ask yourself one question. Who is on the other side of this trade? If I sell, who buys? The answer is the banks, the institutions, the Chinese wholesalers, the industrial accumulators. They are using the fear to acquire your assets at a discount. Do not let them have your stack. Fifth, prepare for the pivot. The crash was the problem. The dealer lockout is the reaction. But there is a third part to this story, the solution. The volatility we saw today has caught the attention of the highest levels of government. The strategic implications of a broken silver market are now being discussed in Washington. The dependence on foreign supply for a critical industrial metal is now on the radar of national security advisors. We are entering a new phase, a phase where the government recognizes that low prices are not a benefit, they are a threat. Low prices destroy domestic mining. Low prices encourage foreign accumulation. Low prices transfer strategic assets to competitors. The cavalry is coming, and when it arrives, it will not be to suppress prices, it will be to support them. This is the end game. The paper game is dying. The physical reality is asserting itself. The price on your screen is about to catch up to the price on the street. Hold your stack. Trust the metal. Ignore the noise. The real price is $120. The banks are out of ammunition, and the next move is up. We will see you in the next broadcast. Until then, stay strong, stay stacked. And remember what we always say, if you do not hold it, you do not own it. The paper crashed. The physical exploded. Now you know which one to trust.